So pay attention. So it's really a very simple methodology. Let's just say, which I do and we do have some bearish positions, right? So these are the bearish positions. Maybe you've got a call vertical on Apple. Maybe you've got some shorts on the banking stocks and retail stocks and Tesla and who else, you know, who knows what you have. You've got enough bearish position here where you've got enough at risk that you really don't. I mean, even if you lost 50%, it's kind of a chunk, right? Let's just say you knew what 70/40 means, right? It means, well, part of it here is if these are all pilot positions, you haven't added to anything. Now, I've added to a bunch of these, so I am way into my positions here. But let's just say you put on some pilot positions, starters, right? And you have it in your trading plan that if any of these positions get down by 70% or losing 70%, you're going to exit them. But when you add all of these up, maybe it's, $150 each. I don't know. You add it all up and it's like maybe you add it all up and comes to $800. So that's a good amount, Maybe you only have like a $3,000 account or something like that. So this is, 20, over 25% of your account at risk. You don't want that to lose that much. So the point is that if you have exposure to one side, this is called directional exposure, right? Meaning I am pretty bearish. This is the direction that I've opened up these trades for July 18th. That's the monthly expiration, which is really the best way to trade once you have conviction on, your narrative is confirmed and you believe the markets will go lower. The best thing is to go out 2 to 3 weeks and start putting in little starter positions there. They're less expensive. You've got plenty of time for things to work. But now you're thinking, well, I've got this at risk here. I think I need to put on some kind of protection, some insurance, just in case it goes the other way. So I'm going to draw this in yellow. So the proper way to do this, so today is Wednesday, is you look at this and go, I'm going to put on some kind of hedge so that if between now and this Friday, because you can't control what happens next week, right? So in fact, if you had decided end of last week or even the beginning of this week that you wanted to put on a bearish position, and let's say you put it on for here, let's say you shorted Apple. Let's say you got the 195, 190 put spread on Apple, and it cost you $1.80, and you got 2 of them, and so that's $360, right? Let's say that's for next week. Okay, it's the same scenario here. How do I hedge this? I want to put on little hedge because if the market does that into the close on Friday, you really need to look at the market, the options market, if you're swing trading, in weekly increments, right? What will happen this week? Because then you have the weekend where the markets are closed. There's all kinds of news that happens and things that go on around the world over the weekend. And then Monday's a brand new day, a brand new week of trading. People start buying options and the whole thing starts over again. So good idea to look at it in weekly increments. So if this is to this Friday's expiration, what you could place is a trade that would gain value if price moved up. That's called a hedge if you are bearish here or here. So what kind of trades could we do? Well, you look at the markets overall and say to yourself, well, if tech stocks all of a sudden blew up, Apple, Amazon, Netflix, Tesla, all Nvidia, all the tech stocks went north. Well, that's QQQ, isn't it? Which is really makes sense. You're either going to want to go with that index or the Russell IWM. Although if you look at the Russell, it looks kind of weak. I don't think I would be this week anyway using the Russell. And then obviously you have the SPY. Well, if you look at QQQ calls, the price of these calls for Friday, they're really expensive. You can even go a little bit out of the money and they're like $3, $4. That's way too much. 300, 400 for one call. You'd have to have a $6 or $7 move for it to make anything. Plus you've got the theta decay. It's just, it doesn't make sense to spend that much money on a hedge. So ride the pony. You did do one right thing is that you got a very cheap hedge. I think you went way too far out of the money. Um, but we'll talk about how much you can invest. My, sort of a ballpark is you never really want to have more than 10% of what you have at risk here in your hedge. So in this scenario where I have 800 over here, you could spend $80. Yeah, you could do that. $80 ain't bad. Because if you got a triple, which you would on a good hedge, should be able to give you a double, a triple. Let's just say you got 3x on that. You made $250. Well, if you got out of this trade, let's just say with 70%, oops, with 70% down, right? You would have lost 560. And if you made 240 off of this little $80 hedge, what did you really lose? Well, it means you would have only really lost 320. That's less than half of what you had at risk. That's not bad at all. And maybe some of these trades were still alive, or maybe you got out of it 50% or eased out of them with less pain. So 10% is kind of a good rule to look at. You don't want to spend too much. So the idea is for the front week, the short week, short term is the best way. Not that the 27th, why does this keep happening? Not that the 27th next Friday is long term, but if you have trades on that expire next week that are short, then you put your hedge on for this week. So what that does is gives you protection. So I'm going to explain what happens. This is the really cool part. So let's just say the markets went in the direction that you like, down between now and Friday. Well, that's good. That means these are profitable. In fact, these may be so profitable that you don't have to hold them into next week and you could take profits early. That's called feeding the pigeons. You could do that if you wanted to, right? I was just looking at $50, 500, actually 5,000 contracts total. Yeah, I don't know what you're doing there. Okay, so just pay attention. So if the markets went in your direction, you'd make your money. There might still be a little money left here with the hedge. Let's just say not tomorrow. The markets are closed tomorrow, but let's say the markets were not closed tomorrow. And Thursday, the markets dumped and you were able to make your money. You have a couple of things you could do. You could close it. Great. Well, what do I do with my hedge? Well, if your hedge is still worth something, you could close it, right? And if you had any trades over here, you know what else you could do with this short-term hedge that you now no longer need because you got your profits here? But if you also had something out further in July, you could roll this hedge to the next week, to the 27th. Cost you a little bit of money, but not too much. Now you'll have a short-term hedge on the 27th to protect these in July. Does everybody understand that so far? So, first example, you've got next week's, I'm just going to call them puts, just so you know which direction. You have next week's puts. And then, so this week, you get a hedge. And so if the Qs are too expensive, In terms of calls, that's why Ride the Pony followed my suggestion, right? So he went with SQQQ, which is an inverse. And these typically, if you can get just slightly out of the money, they're usually around 40 cents. So if price is at 22.30, you can get the 22 puts for like 30, 40, 50 cents. So you could get 2 of them. And that would be perfectly fine. When do you get it for? For this Friday. It's a short-term hedge for next week's put. And what can happen is if the markets move in your direction, you can close your puts for a profit, or you can hold them, or you could close some of them and hold some of them. But the hedge is no longer needed because now you're in the money over here. So you could close out your hedge and preserve a little bit of capital, which is great. Now you got a little bit of your insurance money back, and next week's are good. If you close this out completely, you don't need the hedge anymore. So you close out the hedge. Everybody understand? You don't need it.
Thanks for watching. Hope you enjoyed this video from Trade With Me Now. Make sure to go ahead and like this video and subscribe to our channel so you make sure that you catch our next video right when it's released. Also, if you have a question or comment, please leave that in the comments section below. And of course, if you want to learn more about Trade With Me Now or join our community of profitable traders, go to tradewithmenow.com. There's also a link in the description below.